Gold has pulled back from its record highs in the wake of the U.S. election, but are there still catalysts that could push the precious metal higher in 2025? Joining us now to discuss, Hussein Allidina, Managing Director and Head of Commodities with TD Asset Management. Hussein, always good to have you on the program.
Thanks for having me, Greg.
Interesting year for gold. You and I have had many discussions about gold this year. We have seen the pullback. Walk us through what we have seen. Why are we at this position right now in gold?
Yeah, so gold has reached many nominal highs this year. We did pull back following the election in the U.S. on the strength in the dollar. I ultimately think that gold does move higher over the course of 2025, 2026. And structurally, we've talked about this before, if we look at central banks in the emerging market, they hold a lot of fiat currency, especially relative to their peers in the OECD. If you look at gold holdings in the US, in Germany, in France, et cetera, materially higher as a percentage of their reserves relative to the fiat that they hold. If we look in the emerging market, most of their reserves are in US dollars, euros, IMF special drawing rights, and we have seen a diversification out of that paper, frankly, into gold, and I don't think that changes. I think it takes multiple years to get to the levels that you see in the OECD. So that structural demand for gold, I think, will continue to support price.
I've heard it described almost as a pause. It's not the central bank buying, which was pretty instrumental earlier in the year, and you've had the discussions that there's more to come. And then if we're seeing a lull right now, it's a pause more than anything.
Yeah, like when we talk to players in the physical market, they contend that these programs from the central banks are structural. You're absolutely right that when you have a large move higher in price, they tend to back away from the market. If prices stay stable at these levels, or if we look back over the course of the last 16 months, as prices find stability, they return to the market. Again, more structurally, I can't call week to week what central banks are going to do. More structurally, when we look at how much fiat these guys hold as a percentage of total, this fiat, which can be confiscated by the U.S. on a whim, as we've seen with Russia and Afghanistan, I think is encouraging these guys to diversify their holdings.
Now, we have seen the price pull back after the election, the firming of the U.S. dollar. I've heard, too, that perhaps the clarity, right? Like we went into the election thinking, are we going to know the next day? Are we going to know for weeks? And then we knew pretty fast, and there was clarity around that. Going forward, though, when you think about a second Trump presidency and some of the policy objectives he's already laid out, what could that mean for gold?
So I think uncertainty tends to serve gold well. And to your point, we saw some certainty following the election a few weeks ago, which presumably lent to some capital pulling out of the gold space. Ultimately, though, when we look at what the President Trump has talked about as it relates to tariffs, which ultimately would be inflationary if actualized at the levels that he's talking about, potentially negative for growth, that tends to be a good outcome for gold. Stagflation is good for gold. And then ultimately, if we look at the amount of deficit and debt and what's going to grow as this sort of fiscal spend is actualized, that's not great for the dollar. And that tends to be, again, constructive for commodities, broadly, gold included.
Now, when it comes to gold in the portfolio, obviously it's been a very strong year for equities. Still hearing, though, from other guests, your colleagues, that still a lot of money on the sidelines in terms of being in cash. Should we start thinking of gold as part of a portfolio? Like, what should our mindset be here?
Yeah, so it's actually interesting. If we look at sort of the performance of equities this year, right, the opportunity cost of holding gold, which does not pay a dividend, does not have a coupon payment like fixed income, your trade-off this year has been I hold gold or I own equities, and equities are up 30% the last time I checked. I think if we get any sort of anxiety, heartburn in the equity space, we could see interest return to the market. If you look at ETF interest in gold, it's been relatively subdued. The amount of retail and institutional investment in gold today is lower than it was 2-3 years ago, and I think that is partially because equities have done as well as they have. As we look into 2025 with equities trading where they are, I don't know that the risk reward is as good there, and that could encourage some flows back to gold.
I think about a picture, a graph that we can look at that sort of underscores what your thoughts here between what we've seen in equities, what we've seen in gold. I'm not sure if we can throw it up on the screen, and there it is. Commodities versus equities. What's this telling us?
Yeah, so just broadly, like you've heard the story from me multiple times, Greg, but when we look at commodities and where they are in their cycle, our view at TD Asset Management is that commodities are going to entering an investment phase. We need to encourage producers to go and look for and bring commodity production to market. It doesn't happen quickly, and that is why you see extended periods where commodity returns tend to average above normal. This exhibit just shows you where commodities, as measured by the Bloomberg Commodity Index, are trading relative to the S&P. from a value perspective, I don't see a ton of downside in commodities relative to equities. If I'm worried about inflation as I head into 2025, if I'm worried about portfolio construction, commodities afford diversification. And again, given where they're trading relative to other assets, they're extremely cheap.
Right, it's been a while since you and I have had a chance to sit down and talk about the commodity space. It's a nice rundown of gold. What about oil? What's happening in that market?
So tomorrow, big day. OPEC meets December 5th to discuss what they're doing with their production. Maybe before we get to OPEC, if we look at sort of 2025 balances, and we've talked about this, on paper, consensus expectations are for a surplus next year, i.e. non-OPEC supply exceeds global demand. Now, maybe where we defer relative to consensus, we're not as optimistic on non-OPEC supply. It will grow, but we don't think that it grows by the numbers that consensus, the 1.2, 1.3, maybe even 1.4 million barrels a day that's modeling. We think, Brazil grows, but probably not as much as being forecast. Guyana and Canada will grow. U.S. growth is slowing. So I think we do see non-OPEC supply growth, but I'm not sure it's the 1.2, 1.3 million barrels a day. On the demand side, again, we're probably slightly more constructive than consensus. Consensus is using 800,000, 900,000 barrels a day of growth. If I take those two numbers together, the 1.2 from non-OPEC, 900 of demand growth, I have a supply-demand surplus from a flow perspective of 300,000 barrels a day. I don't need incremental OPEC production to satiate balances next year. OPEC has kept production offline for an extended period of time, and there's questions around their willingness to continue to do that. Some members, in particular, the UAE, which has spent a tremendous amount of money to grow their production, might want to bring supply back. Ultimately, I think, look at where inventories are. They're extremely tight. Yes, even if I have a surplus next year, risk-rewarded oil still looks favorable because I don't anticipate OPEC to flood the market. I don't anticipate a market share battle. And I think that we're not looking at the risk to supply. Again, President Trump is going to be, I think, far more hawkish on Iranian production than President Biden was. Iran has contributed over 1 million barrels a day of incremental supply to the global market in the last 16 months. That number probably doesn't go to zero, but it probably does move lower from where we are today. And that allows OPEC to bring some barrels back to the market, which lowers spare capacity. You have to introduce some risk premium to the market.
I was going to ask you that. I mean, American benchmark crude, West Texas Intermediate on my screen below $70 a barrel. Is there any risk premium in the price right now? Because I can't keep up the headlines.
So I think that those who have played sort of this idea of supply disruption, they've bought call options to protect, to hedge against that. It hasn't happened. The last time you got paid, I think, buying calls on oil was when Libya fell in 2012, right? You have not had a meaningful supply disruption. So I don't think that there's much at all premium in the market. If you look at CFTC positioning, non-commercial positioning, there's very little spec interest in the oil market, and I think this is because of that bearish view on 25, and I think we're probably going to be surprised. Again, I'm not calling for $90, $100 oil, but I think that sort of prices at these levels are fair and justified.